CEO of BrunnerInvest, is with us. Welcome.
Thank you.
It's a real pleasure to have you here and to learn from your vast experience in the business. Perhaps we could start with learning a bit about your background, and if you could tell us what got you interested in investing to begin with.
Well, if you just ask that question, I started to speculate on the Swiss Stock Exchange when I was 15. So I have a long career in investing and I have a long career in stock picking. I don't do any more stock picking, I do today fund picking. But my initial career started at Swiss Bank Corporation here in Zurich. And I've been more than 20 years with them. I've been in between in New York with Kitty Peabody. I've been in London at the Swiss Mercantile Society just to learn a bit English. I've been in Bradford in England just again to learn English with Santos Products Limited at the time. Today it's Novartis or a part of Novartis. Then I moved back, I moved to Geneva and I've been working with Swiss Bank Corporation Geneva for a number of years on the asset management side as well as on the portfolio management side. So in this type of business I've been a long time, let's put it that way. Then in 72 I came back to Zurich. Again, a long time ago, again to Swiss Bank, and at the end of my Swiss Bank career in '88, I led the investment part of the Swiss Bank Corporation Zurich. From there, some kind of headhunter managed to move me from one bank to the next, and then I went to the Rothschild Bank, again here in Zurich. I was managing the Rothschild Bank in Zurich for 3 years until the 91, and late 91 I started my own bank, my own company career. And during my Rothschild period, I've had the opportunity to meet Soros and to meet Bruce Kaufner. They have been the exciting managers of those years. And the Rothschild family at that time has had, I still have it, a fund of fund, and I felt that is a good way of making money and also finding good managers worldwide. And it's an easier administrative way. So I came in the fund of fund business. And when I started in '91, my own company, initially I had some private clients. We manage private money for private clients here in Switzerland, Swiss clients. And but later on, for lean management reasons, I started again in the fund of fund business, the second part of the '90s. And since then, I've been in the fund of fund business. And today we have 5 fund of funds, 4 in Dublin and 1 here in Switzerland with Falcon Bank. The ones in Dublin are with UBS Dublin, and I think we do not do such a bad job.
Well, this is certainly a very, very long career in the investment business. I'd be curious if you could tell us a bit about how the industry has evolved over the years, perhaps some examples of where you see some opportunities today, or what has become harder today, either in picking managers or picking specific stocks relative to, let's say, 20 or 30 years ago.
Well, the fund of fund business, the development of the fund of fund business, the fund in which I take part, which the name is called Leverage Capital Holding, LCH, those years, has been one of the first one and has been launched in Switzerland. I don't remember exactly when, it was in the late 60s. At that time, there had been a new fund law in Switzerland and which in principle prohibited hedge funds and fund of funds. But that fund at that time was launched outside Switzerland, so it was an offshore fund. But I felt it's a good way. When I started 20 years back, you did not see a lot of fund of fund business in Switzerland. There really was almost nothing. Just the one I mentioned, and in the middle of the 50s and at the second part of the 90s, there was still not that many. But by 2007, we have had 42 billion Swiss francs, or more than that in dollars, which had the right to get publicly sold in Switzerland. The situation at that time, Switzerland has become big, and I think it's the second or third biggest nation with fund of funds. Now the 42 billion have been the funds which you could sell publicly in Switzerland. A huge amount of other fund of funds which you were not allowed, but you could sell it to institutional clients. Today the 42 million after 2007 has decreased substantially, and from 42 million we're down at 10 billion. So if you can imagine, the whole market lost 75%. And one of the reasons definitely Madoff, because a lot of Geneva banks and Geneva asset managers, they used fund of funds where they had Madoffs in it, and so this killed the market. And also we suffered as well. We never selected Madoff. I had all his papers on this desk here, but because of our due diligence reason, we did not select him. I had the opportunity. I was in New York. I wanted to see the manager, but I was too small for him to see me. So I said to the hell, I don't give somebody money which does not want to see me. Then I've asked for annual reports of the custodian, and the annual reports I had to claim 3 times annual reports. At the end of the day, I got annual reports about 6 pages. Unfortunately, I don't have these papers anymore. It's a pity. But these papers have been written on what we had at that time, Hermes 2000 typewriters, you know, no PC, no nothing. I didn't know who issued this annual report, but for me it was a crystal clear sign, don't touch this fund. I was very lucky. But still, the Swiss market decreased because of Madoff. We have had friends which were invested, we have had the side pockets, I think there are still side pockets around, and that was not so good for us, so the market really is down. And right now the Swiss investors and pension funds, they still mistrust the fund of funds. I think it comes back. I know in the US the fund of fund business back to before 2008, but here in Switzerland usually takes more time, so I would guess another 3 years.
Can we step back a bit, and I'd like to understand what your investment philosophy is, and when it comes to the managers you do select, what do you look for in these managers?
Well, the fund has, in principle, is already some kind of portfolio management. It's a substitute for portfolio management. Now we have 5 fund of funds, but we separate them geographically. We have one Asian one, we have an emerging market one, we have a European one, we have a global one, and then we have one which is 50-50 China-Europe, because I believe strongly in China. And it's not so easy to find good managers today. It's easier to find good football players tomorrow because the coaches, they go to U17, 21, European Championship or World Championship, and then they find the right next talents. We don't find that easily the next talents. But the principle, all talents, there have been talents before. Most of the good managers today, they have been at the big house, Goldman Sachs, Credit Suisse, Morgan Stanley, whatever you wish. And then, because they've been good, they start their business themselves. When they start the business themselves, they're some kind of emerging manager, which is not true. These are people which are 30, 40 or 50 years of age, which have had a lot of experience. And then they start their own business, which is a challenge definitely for them. But then obviously I always look first of what they have done before, how successful they have been, with whom they have been. And then I don't give them the first day money, but we have given them already after 12 months, 6 months, 18 months money. But we wanted some kind of proof that they seem to be okay. I, in principle, quite loyal to a fund manager. If I feel he's good, I go on keeping it for years. But if I don't have a good feeling, after 6 months I get out again. I'm very fast. And I think I'm faster to be out again than other ones, the big banks, which it takes more time to get out because all the committees have to decide. We are a small team here. I think we are faster and better.
Now, when it comes to the strategies of your fund managers, can you give us a sense of what's the range of strategies that your managers employ?
Yeah, number one, I want to beat the long-only indices because I think today I fight against ETFs. And we have to be better against indices over, let's say, an economic or a stock market cycle, which is usually 5 to 7 years, something like that. So we look for managers where we have the feeling they are better than the indices. And then obviously we have expenses, we add these expenses, so I like to have, let's say, I must have the feeling that the manager beats indices plus 3, 4, 5%, otherwise it's not worthwhile then afterwards for us to go into this type of funds. Now, from a geographical point of view, I mentioned them before, it's valid somehow everywhere. We most of the time use European funds, and I would say, I'm not quite sure, but the 60% of our fund managers are sitting in London, and 40% in Asia. In Asia would be Hong Kong, would be Singapore, even Beijing. We don't use that many US managers right now, because we still have the problem with FATCA. We don't know exactly how this will come out. Now, we put the portfolios together in long short, long only, and what we call tail risk products. There are periods where we take the decision, we must be flexible to take some kind of market timing. I think this summer we will have a chance again to buy long only products. Right now we only have a gold fund which invests in gold companies. That's the only long only product which we have as of today. But I think we are going to increase the long only products again this summer, which means we will decrease slightly the long short products on one side. On the other side, after 2008, mainly Swiss pension funds have discovered that it is good to have some kind of tail risk product. Now it's not so easy to know what is a tail risk product. It's not an official definition of it. So, but we define it like that. We use CTAs. The CTAs, they've had a good commodity trading advice. They've had a very good performance in 2008. The next 3 years they have not had such a good performance, but the next drop will come again. So CTAs definitely belong to this type of products. We use gold and platinum ETFs. Right now they are down, but I still think in a crisis they will come up. And then the third group which we use right now are volatility products. So we have we selected one volatility fund, which for instance in May, which was a difficult month for us all, produced 22%. And you're pleased to take such a performance. Now after May they're down a bit, but the other ones are up. So it helps you reduce the volatility. And I think over the last years, at the performance, we have at least been beating the long only these, but at the half of the volatility, which I think is not bad. But again, volatility, a lot of people think volatility, it's a definition of risk. In my judgment, it's not so much a definition of risks. My judgment of risk is a philosophical question. In principle, it comes very simple. I hate if other people make more money within 3 years than we do. That is risk. And not if it moves up or down within a month. If you buy bonds over 5-10 years, you also keep the bonds for 5-10 years. So in our system, it should be different. Unfortunately, people, they get every month a bank statement and then they see it's up or down, and they have problems, they have no problems. But it's a different definition of risk.
You say that the first and most important rule of wealth management is to avoid losses. And I'm curious to understand how do you go about that? How is that reflected in your portfolios?
Well, you have the biggest volatility and losses in the long-only industry. So if you feel markets go down, what we felt this March, we sold all our long-only products. We are today in an environment where you cannot buy and hold for 20 years, as it was the case in the 80s and 90s. We are today in a market which is highly volatile, goes up and down, you don't know when it starts, which way. So it's worthwhile you must be flexible, which means you must take care of a market risk as well. So we obviously increase the volatility in buying long-only products when we feel markets are low, and we try to get rid of them again when we feel markets have moved up 6 months or something like that. And you can understand if you go, let's say you invest 100, you go from 100 back to 80, you only have to recover 25 to be again, let's say, break even from the high of where you invested. But in the world indies, for instance, in Switzerland, over the last 10 years has decreased 50%. So 100 today are only 15 Swiss francs, which means you have to double your money to be break even again over what you invested. That's my thinking, that's risk, and not so much Sharpe ratio, volatility risk and things like that. But I know I speak against a lot of mathematical professors and consultants.
Well, we certainly share your view of that, and would not look to volatility as risk, as a lot of the academic work suggests. I'm curious, you talked about some of the compression of the time horizons, and doesn't that represent an opportunity? We are here in Zurich, and you have a lot of private clients that presumably can think very long term and may therefore have an advantage over institutional managers who are much more constrained in the time horizon because of the relative performance and the career risks. Can you give us a sense of whether you think that's an opportunity and how do you take advantage of it?
Well, when you get a new client, they pay you a fee for being a client of yours. They immediately want to see success. So it's not so much a difference between a pension fund or a private client. It is a question of educating them. It's a question of teaching them. It takes a long time and not everybody understands it initially. So my experience has been let's say, teach or educate somebody the first day, and then 3 months later on I see this private person again. I really just feel I have speaking against somebody which didn't understand anything. So I have to repeat it. It's a lot of information, education, and repeated education. That's true for pension fund, it is also true for private clients. It's not easy. If you are lucky, somebody gives you 100 and it just goes up for the next couple of months, there you go. Well off. But you can also have the other client, he gives you money March and in July it's down 20%. That's not so funny. You have to repeat what you have said. So obviously it's a continuing discussion between client and us.
And with all the discussions that you have with your clients, I'm curious, in terms of the noise that we currently have in Europe around the crisis and the uncertainty, from where you sit, what are some of the key messages that you have in terms of managing capital and perhaps taking advantage of some of the opportunities that this crisis represents?
Well, crises are always good opportunities to invest. The question if people are still liquid to invest, that's the question. And if there's sunshine, blind people don't see the sunshine, and a lot of investors don't see the sunshine. If you take world markets right now, which is true for Europe, US, for Asia, you hardly find price earning ratios as low which are today. Europe is about 8 times price earning ratio forward earnings. That's very low. The average has been 15 times over the last 15 years, and if I look back 30 years ago, it was higher as well. So there is an opportunity. But this opportunity, we don't know with all the problem on sovereign debts, how fast it will be solved. So I could imagine we have another 2 or 3 difficult years ahead, which difficult means very volatile. So you must stay flexible. I think the opportunities like we have this summer, but sometimes late this year or early next year, you have to get out again. That's not so easy for private clients. Now, I'm sure it's better we have a private, a professional advisor, which tells you or which does it for you. I think that's a better way. But the chance, if you look back 10 years from today, you just remember that was an opportunity.
You talked about that most of your managers are in London. Where are they finding the best opportunities now?
Well, most of them, they're geographically. I mean, you have the long-short business. I mean, you have European long-short funds, you have Asian long-short fund. That's not quite true in Asia. It's a big, huge area. So you have Japanese ones, long-short. I don't like them so much. They're not so good in long-short. But you have other Asian, Asian long-short funds, which are quite good. And the majority of them is all again managed in London. I've just met last week a number of them, and another number are in Singapore and in Hong Kong. So we travel quite a lot there to see the managers on the spot. There's enough of opportunity. My only question is always, why always London? And I think it goes back to Thatcher from the Big Bang. When was it? 1960 or 7? No, 86 or 80, something like that. And she changed the law for English funds, which made London much more attractive than other places in the world. And I always ask the people, are English people so much more intelligent than other ones to be sufficient or efficient? That's not true. England has become a place where people want to go just to learn the hedge fund business, the long-short fund of fund business. And you find the Australian ones, you find the Americans, you find German, French ones, you find people from every nation in this whole world which just went to London and they are successful. So the environment for London comes from that period, I assume.
To come back again to what you do as a core business and core task at your firm is to pick the right managers. Can you give us some insight into how do you go about it? What is the process? Are you more focused on the numbers, the documentation you get, the person? Can you give us a sense of what the process is?
Okay, I mean, every manager which we select has been somewhere successful. So you get a number, and when I look for the number, I always look for the numbers, past numbers first. I always look, and I see immediately that's a number line which I like and which I don't like. When I see it, then we ask for the marketing material, we go into their papers, we ask for their prospectus, we deeply study the prospectus, due diligence, whatever is on the paper line. We, as I mentioned before, you see the annual reports, you read the annual reports, and when you still feel that seems to be okay, it's all right, then we try to see the manager. So we don't give money to anybody which we have not met. It can be here in this office in Zurich, it can be in London, it can be anywhere. So last week, as I said, was again in London. I met the managers, new ones. But Zurich has the advantage, let's say, like London, a lot of people travel to Zurich. So they have our address, they come to us. Or sometimes we find managers on a scale of some kind of ranking, the number of companies which issue, and then we see they have good numbers, then we try to get information on them. I don't want to use too many managers. So I think through the firm we right now might have a bit more than 30 long-short funds. We might have about 10 to 20 long-only funds, and we have about, I would say, about 10 tail risk products. Just to imagine, so it's a concentrated way. It might be 60 names which are of our screening list and of our buy list, if you wish, and we follow them very closely, which is monthly through personal contact or just reading their papers. And as long as things go well, we don't need to see them. We want to see them when things don't go that well, and possibly even before. Or if one is successful, then the question is, why was he successful? And then we have to go deep into it to find out, is with that strategy he successful again in the future? Because we don't know the future, we only know the past. But you have to need a feeling. I've been a very long period in this type of market, I understand the business, so I want to have a good feeling. And I remember very well what somebody is saying.
And so what is it in terms of the judgment when you, ultimately it's a people business, so perhaps some of these softer factors, what do you look for in making a judgment about the person?
Well, you know, it's a fight between your head and your stomach. Your head, he decides to go or is no go. But then still you have a stomach, and you must have the good feeling. From the numbers, I like to see 3-year numbers. So we look right now 2009, 10, 11, and the first 5 months of this year. So I don't look for 5 years or 10 years. Quite often there are different managers or different teams, and it's not anymore, if somebody has been 10 years ago successful, like Soros or Bruce Kaufner, you don't need to subscribe anymore into their products today. So I rather look for the last 3+ years. And then I try to compare them with each one, and then I again try to find out how they have done it, and can they repeat it, and will it, according to my judgment, be the ones which we need for the coming months. Obviously we have a political situation, we have an economic situation which we analyze as well. But once more, it's like an elevator, it jumps from your head to your stomach and up again.
When it comes to the successful manager trades, and you talked about some of the world's greatest investors here, can you share with us some of the perhaps experiences you had with some of your managers, the good ones and then the bad ones, and what perhaps are some of the commonalities that run through that?
All right, let's start with the bad ones first. There have been, I have a name in mind, I don't like to say the name, of a very good long-only manager, and he wanted to, it's an English person, he wanted to move in the long-short business. And he just had good ideas, and he shorted, at that time, European blue chips, growth companies, and he was long East and North European small caps. And just at the time I have in mind, just the gap opened. The small caps went down and the blue chips kept up. So he lost in no time 20, 30, 40%. And he's an excellent long-only manager. I still know today he's an excellent long-only manager. So good long-only managers, and a lot of the long-short managers, they have been long-only managers in the past. That's no guarantee that he's efficient as a long-short manager. Good managers, well, in the past definitely Soros and Bruce Kofner. I always ask the question, are these people more intelligent? What's the difference between them and somebody else? I think all of them are fanatics. You know, and perhaps I exaggerate a bit, but Sunday morning in the church they don't so much listen to the priest, they rather listen to their brain and they have a position in their head. I would say they are 7 days, 24 hours a day, fanatics, and they're thinking over their positions. It's definitely they are intelligent. All of them are intelligent people. All of them have experience. But the majority of them is really fanatics, and it has not changed today.
Can we talk a little bit about some of the products? You mentioned the tail risk products. I'm curious, what's the rationale for these products in your view, and what are some of the tail risks that you think are the most important ones to guard against, and how do you do it?
All right, let's start with the simplest one, which would be gold. Gold, for instance, in 2008 increased by a bit more than 4%. It's not a great increase, but if you compare it against stock markets, you still were happy you have positions at plus 4%. Then you have had the CTAs, the managed futures, the commodity trading advisors, CTAs we call them today. They have done a bad one, did 20%, the good one has done 100% performance in 2008. So really, they have had a trend. They're all trend followers. They're short-term trend followers, they're medium-term trend followers, and they have, if the markets really decrease, they have a trend, and that's the way they make money. Then the third group, which we use today, we use them about 1/3, by the way. We use them about 1/3 precious metal, 1/3 CTAs, and 1/3 we use the volatility funds. The volatility funds usually they buy 3 to 6 months volatility fix on the Standard & Poor's 500, for instance, forward, and to decrease their fees they short the 1 month. So if markets go down, the long-term volatility shoots up, and then you make a lot of money, and the short-term volatility obviously goes up as well, but you lose less money. That's their strategy. That's why, for instance, this product I mentioned did 22%. Right now, the volatility is around 19 times. The low in summer, I think, not in summer, about 2-3 months ago, was about 15, 16 times. But last summer, in 2011, the volatility was 45. And you don't know when the next high volatility is coming. I'm sure with this sovereign debt problems, which we have today, volatility sooner or later comes back. And then these type of products are good for such an environment. If you are in a buy and hold market for 20 years, like we have had the 80s, 90s, which probably come back again in the 2000, 2020, 30, then you don't need such products. Then you can go back into the long-only business, perhaps long-short business. Why do I speak of 220, 230? Because Warren Buffett, he says that in the US market, and I follow the US market because it's a guideline for all remaining world markets, Europe as well as Asia. He speaks of 16 years, so 16 years markets. I think that's wrong. I think 18 years would be better. But it's not 18 years, it's 15 to 22 years. It's still 7 years in between, and you can be wrong losing all your clients if you are too often wrong. But you have a 20, let's say 18 good years, and you have 18 sideways market. I call them sideways market. Most of the time, these sideways markets, in the middle, they've had their low. You can go back 150 years, it's true. You can copy it yourself. So I think the 2009 trough has been the trough for this bad cycle. But I don't see a bull market now immediately starting today. So I think we have 3 more difficult years ahead, which means about 250. And so you must be flexible and probably take decisions to trade, even funds.
When it comes to selecting your funds, and do you have a worldview and then look for the managers to implement that worldview, or do you look for the managers first and then give them the rein wherever they want to go?
Well, obviously in the long-only fund you must have a macro opinion of what the markets could be doing. Let's say right now China, I think it's a very cheap market, it's the most cheapest market in Asia. So you should be long-only, China long-only. If you talk China, in principle you must have a macro opinion. But again, I repeat, we're worldwide except the US right now, so we know what's happening in Europe, we know what's happening in Asia, or at least we hope we know what's going to happen in these areas. And we are just very careful. Yeah.
Perhaps we could talk a little bit about China. Can you give us the reason, or why do you think, first of all, the market is cheap, and what makes you confident that it's an opportunity?
Well, obviously China has been a frontier market. Today it's an emerging market. Amazing, the daughter company Hong Kong is not an emerging market. So, but Morgan Stanley decides, so don't ask me. China, you have had over 30 times earnings about 3-4 years ago. Right now the Chinese market is about 8 times earnings, which again, it's on the low side from that one. But on the other side you have the growth. If a bad year is bad, they have 7%. They judged, I think the government wants 7.5% GDP growth. Perhaps then at the end it will be 8 again or 9, doesn't matter. I don't mind if it's 6 or 10%. I mean, it's a nice number. If you have in certain macro environment good results, then it's obviously easier to find companies which make more money. It's more difficult here in Switzerland. We have 1-2% growth, so find good companies which grow 10, 20 or 10, 15 or 20%. In China you find it for the time being at low rates. That's what I said today. In 10 years you will look back, why did I not buy at that time? But you have to be patient, it's crystal clear.
And how do you go about implementing that exposure to Chinese growth?
Again, there we combine long-short and long-only managers. I think that the best ones, the ones which we have, are sitting in Hong Kong. One of them is a combination that have offices in Beijing today and in Hong Kong, and they've been very good. They are more volatile. One of our funds is 50-50 Europe and China. Why 50-50? Because Europe gives a lower, or helps to have a lower volatility, and China has more growth. China, definitely it's a growth area, and if everybody right now is anxious in China, that will not be the case. They will regret it 5 years from today. But short term, it's cheap, it's big, and we buy long short and long only managers through the company. I think we have about 5 or 6 funds right now which we have.
Are your managers investing mostly in Hong Kong listed companies?
No.
Directly?
No, it can be both. I mean, you find, I would rather say Greater China. Well, Greater China, they define Hong Kong, Taiwan, as well as China, the old big China. So they're also very much related. A lot of time and money is invested also in China, so you should speak of Greater China. And the potential is rather there, and you can buy, a lot of good companies are quoted in Hong Kong, but you can also buy them in Beijing.
So what would you say to people who are concerned about some of the excesses that they say are happening in China, and does that concern you?
Well, you know, obviously there are still the political risk, the human rights and all these things. We have had them 10 years ago, we have had them 20 years ago, and I think things are slowly improving, definitely. But we cannot expect a nation which has been living for 50 or 80 years on the wrong side to move immediately or change immediately in a democracy the way we have it. You have the Chinese Communist Party, but you know, if you want to go up the ladder in the Chinese Communist Party, you have democracy like you have in England. You have to get voted. It's not exactly our system, but it's not in the whole world. We need to implement our system. Somehow internally it's democratic as well. But still in this Chinese Communist Party have extreme capitalists as well as the extreme left people as well. So it's combined in that one somehow. But they still try, the problem of the Chinese government is still to find a way to bring a lot of old poor people somehow to give them some kind of money in order to avoid riots. And so I think economically do a lot of positive things. and this will help long term that the rich people also try to keep their money. If you go back into the United States, initially you had the fights on the railroads, and that they just were stealing your land to build their rails there. And when these people have become rich at the end, they tried to become democratic so they could keep their money. I think this will not be a big difference in China long term. There's really opportunity, but obviously more volatility, also more risk. It's not the European standard, not yet.
And to flip that question around, so are there any markets that you don't find attractive or stay away from in principle or at a certain price?
Well, as I said, from a valuation point of view, it's difficult to find expensive markets today. There have been periods where it was difficult to find cheap markets, but right now it's the other way. We avoid the US market because of FATCA, that's one reason. But the world is big, there's a lot of opportunities. We did not mention Africa. You have a new generation of emerging markets, which we call today frontier market. I think there's a lot of potential there as well. It takes more time, it does take more time, but again, if you buy them today, 10 or 20 years from now, it will be, I think, well established. We started, just to give you an example, 20 years ago to buy Russian companies, not companies, we bought funds which invest in Russian companies, and it has been a very fruitful investment over the last 20 years. But again, very volatile. Only if you think back 1998, where you have had a huge decrease at the time when Yeltsin did not honor anymore the GKOs, the market dropped 80%. You were swearing for about 2 years, but then you have seen your money again. And today Russia is still cheap, it's about 5 times earnings. So Russia, it might be an opportunity as well. But don't buy companies there, just buy funds which invest in companies. I would not suggest anybody buying directly companies there. Well, you can buy Gazprom, which is a huge company. I think you buy them in New York as well as in London as well, but I would not concentrate on Gazprom. You should have a bigger portfolio.
Now, you've seen many managers come and go. Based on your vast experience in the business, what advice do you have to young people who are interested in the business of managing money? What do you say to them?
Well, you're speaking of people which want to invest their money or people which want to become investment managers or fund managers?
Well, if you could maybe give us the difference. Some would say there shouldn't be a difference in the way you invest your own money and your clients' money. So I guess what I'm trying to get at with the noise that we have in today's world, a lot of people are drawn to Wall Street and to start their careers. Perhaps you could give us, if you had to start out over, what would you do?
Well, as I told you before, I started to speculate when I was 15 years of age. So you're not too young. Obviously, you should not be lower than 15 years of age, but I had a bit money there, and I didn't do that badly at the time. But you have to get into the market, and it takes quite a lot of experience. You don't become just overnight a good fund manager, or even not for yourself. You also must lose from time to time money to learn how you should do it. Obviously, when you become bigger, you make more money, you have more reserves. Initially, you have almost no money. You might be near to bankruptcy, but you should not give up, definitely not. If you just have money as a young person and you think long term, or you earn too much in your salary with a company, then definitely emerging markets are the most attractive place to be. Today, yesterday, and will be in the future for quite a while. So I would, for these young people, just suggest to go in this type of markets. But stick to the fund business or fund business, at least fund. Long only funds are okay in this market. And don't swear too much if things might go wrong for 6 months. Just go through, forget it. Don't forget it, but think you have some money there.
Well, on that note, thank you so much for your time.